Hi guys, welcome back to Live Richly. My name is Ike. I work in financial advice, and the goal of this channel is to give you guys the best tips and tools to better understand the world of personal finance so you can reach your goals and get ahead. So in my last video, we talked about investing and the basics of investing. I gave you 2 core principles, but I also gave you 5 tips based on my personal experiences that have made me a better investor, and hopefully you guys can use these as well. So I'll link that video in the description below. But today we're going to be talking about ETFs, managed funds, and index funds. A lot of people confuse index funds and ETFs. It's a bit of a pet peeve of mine. So hopefully by the end of this video, you're going to understand what these 3 investment tools are, how best you can use them to achieve the goals that you want to achieve, and the disadvantage of all 3 of them. So at their core, these 3 investment vehicles allow you to outsource your investment decision making. And this is something that's really beneficial if you're a new investor and you don't know where to start, or if you're someone that just wants a simple, no fuss approach to investing. It's going to be a good one. These products are readily available for everyone, so let's get into it. So the first point of call is to understand what is an index. So you probably watched the news before and someone has talked about how the S&P is up 5 points or the Nasdaq's an all-time high. And these are examples of indexes. And what an index does is that it allows you to track the performance of a collection of companies in a standardized way. So the most popular index in the world is the S&P 500, and that allows you to track the top 500 companies in the US. So using the US as an example, if you wanted to know how the markets were performing at any given day or any point in time, instead of looking up the share price of every single company, you just look up how the index has performed for that day or at that point in time. So just keep that in mind, that an index is a tracker. And in this video, we're going to be referencing the S&P 500, which tracks the top 500 companies in the US. So what is an index fund? An index fund is a pool of funds that is managed by a funds manager, namely a Vanguard or a BlackRock. And what they will do is they will buy shares in all the companies in that index, package that together as one investment product, and that investment product is the index fund that you and I can invest in. So with this one product, the index fund, you get a piece of ownership in 500 companies, you pay one fee, and it's just one transaction. The manager in the fund is going to be making buy or sell decisions on what stocks they can add into the index fund based on what's happening in the index. And this type of investing is called passive investing. So there are 3 things that you need to know about an index fund. An index fund does not trade on the stock market. And because it doesn't trade on the stock market, you have to approach the fund manager to invest your money. You don't go on an exchange. And also the price that you pay is based on the closing price of that day. So even if you put an order in the morning, the price that you're going to pay is the price at the end. The second thing that you need to know about index funds is you have to be an investor that's happy getting an average return. Because an index fund is buying every single stock that's in that index, you're not going to beat the market because you own the market. So if you're an investor who's looking to get an above market return, maybe look at another investment vehicle. But if you're happy getting the average return, which over a long time horizon is actually a significant amount of money, then an index fund is for you. And the last thing that you need to know about index funds, and this is something that stops a lot of beginner investors getting into them, is that there's an investment minimum. And with Vanguard in Australia, that minimum is $5,000. So if you have less than $5,000, probably wait until you save enough money if you really want to get into an index fund, or maybe look at another options to invest in if you really want to get into the market, but you have less than $5,000. Alright, so now let's go into the advantages and disadvantages of index funds. So what are the advantages of index funds? I could think of 5. The first one being you get instant diversification. So if you watched my last video on the beginner's guide to investing, you'd understand that managing your risk is a big part of investing, and the way you do that is by diversification. So with an index fund, with one investment, you're instantly diversified. So that's a big advantage. The second benefit of index funds is that they are super cheap. You're paying 0.75% to invest in a Vanguard index fund. And that's about $7.50 for every $1,000 that you have invested. So they're really affordable. The third benefit is that there's no brokerage fee. You're paying your annual management fee, but if you want to add more funds into your index fund, you're not going to be paying anything extra for any money that you put in or any money that you take out. The fourth benefit of index fund is that they're transparent. So if you're someone who wants to know exactly what your money is invested in, where your money is going, the index fund, you can actually work out to the penny how much you have invested in every single company that they hold. So the fifth benefit, one of the biggest benefits of investing in an index fund, is dollar cost averaging. And what dollar cost averaging is that you're essentially buying more units in that index fund, no matter what price it is. Because you're not paying brokerage fee, you're not paying any transaction fees when you're buying and selling, you're just paying that management fee. Over the long term, you can set up a savings plan, a direct debit from your account, that every time you get paid, a small portion goes into buying you more units in that index fund at no additional cost to you. So now let's cover the disadvantages of index funds. The first one being they're not listed on the stock market, so they're not tradable. So they're not really suitable for short-term investments. The second disadvantage is you need to have that minimum investment. So in Vanguard's case, if you have less than 5,000, then an index fund isn't for you. So the third disadvantage, and I think the biggest disadvantage of an index fund, is that it's reactive, not proactive. So if you've noticed how the stock market has been running hot for a few weeks, especially technology companies, and if you think that the market is going to correct itself or technology companies are going to crash, if you own an index fund, you can't just sell those investments. You have to wait for the market to crash, and then the index fund will act accordingly and will sell down those particular investments. So that's something that you have to factor in if you're going to be investing with an index fund. So now let's cover my favorite investment vehicle, exchange traded funds, or ETFs. And the best way to explain ETFs is that they're actually a love child of a share and an index fund. So you get all the benefits of an index fund, but now you can trade them on an exchange. So not to complicate things, in this video, when I refer to ETFs, I'm referring to ETFs that are passive or ETFs that track an index. Because not all ETFs are passive, and I'm going to have another video that I'm making that's going to be covering active ETFs and passive ETFs. So now let's talk about the advantages of an ETF. They're cheap, super cheap. One of my favorite ETFs, IVV, which tracks the S&P 500, it'll charge you 40 cents for every $1,000 that you have invested in it. That's pretty cheap. The second benefit is it's also transparent. You can know what your money is invested in. The third advantage is that you get instant diversification, the same as an index fund, because you're essentially tracking the same thing. The fourth advantage is now we're adding tradability. It's listed on an exchange. You can buy it, you can sell it, depending on how you feel the market is going to go. So an ETF is something that you'd use if you're a more proactive investor and you don't want to react to the market. You want to anticipate where the market is going and act accordingly. And the fifth advantage of ETFs, my favorite advantage, is that you get access to subclasses or sub-investments on the stock market. So you can invest in a weed ETF, you can invest in a technology ETF, you can invest in a technology ETF that specializes in Chinese companies. Or you can get an ETF now that's 3 times leverage the price of Tesla. There's an ETF for literally every investment that you can think of. So depending on where you see the market going and what investments you want to take, an ETF gives you a diversified option at an affordable price to make your trade. So now let's talk about the disadvantages of ETFs. If you're looking to invest for the long term, an ETF might not be the best investment for you if you're going to be looking to add to that investment. Because unlike an index fund where you don't pay transaction fees when you add money in, you're going to be paying brokerage fees on an ETF every time you buy and every time you sell. The second disadvantage of ETFs is that they're tradable. And depending on how disciplined an investor you are, you don't really want to be someone who's buying and selling shares. The best strategy that I've seen for every successful investor is you buy and you hold for the long term. And the ETF kind of gives you that option to trade that the index fund doesn't give you. Okay, so now you understand what an ETF is and what an index fund is. Let's talk about mutual funds or managed funds. So a mutual fund is a pool of funds that's managed professionally by a funds manager and their team, and their whole goal is to beat the index, right? So the rationale there is that when you're invested passively with an index fund or a passive ETF, you're buying the market. You're gonna get a market return because you're buying every single thing in the market. But when you're invested with a funds manager, you're betting that that funds manager is going to take an active approach and implement their specialist skills and their knowledge to take out all the companies that aren't going to perform in that index and build a bespoke portfolio of companies that are gonna beat the market and get you a higher return. And for this service, they're gonna charge you a significantly higher fee. The fees have been going down over the past few years because a lot of money has been going into index funds, but you wouldn't be surprised if you're paying between 1 and 3%. It might not seem like a lot right now, but if you wanna compound that out over a 20 or 30-year time horizon, that's actually a fair bit of money. So that's what you have to assess before you invest in a managed fund. How is that managed fund performed? What fees are they charging you? And does that performance justify the fees? So now let's talk about the advantages of investing with a managed fund. The first advantage is that you're getting a proactive manager, not a reactive manager. You're getting a manager who's going to be looking for those companies that are going to outperform or that are significantly undervalued. And you're looking for a manager that's also going to be able to navigate you through something like, I don't know, a global pandemic. The second advantage of a managed fund is that you get instant diversification. The third benefit of an index fund is that you get access to dollar cost averaging at no additional cost. So this is very similar to an index fund, is that you can set up a savings plan that you can direct debit money into your managed fund at no additional cost to yourself. So now let's talk about the two disadvantages of managed funds. The first one being they are more expensive than your ETF and index fund. The second disadvantage being the minimum required to invest in a managed fund is significantly more than an ETF and an index fund. So it wouldn't be surprising to see some managed funds will want to accept anything less than maybe 50,000 as an initial investment to get into them. So that's something that you might have to consider if you're looking to invest in a managed fund. So I'm going to give you guys 3 tips to help you guys figure out which investment is best for you. So why would you invest in an index fund? You'd invest in an index fund if you have more than the 5,000 minimum and you have a long-term saving plan in place and you want something that's simple. So you can take advantage of that dollar cost averaging, set up a direct saving plan and set and forget sort of approach and just be happy getting that market return compounding year on year on year, and you're just adding in depending on your saving schedule. So why would you invest in an ETF? So you probably consider an ETF if you have less than that 5,000 minimum to invest in an index fund, or if you want to take advantage of a specific investment play. So you might be looking into investing into a commodity or into a technology stock. So an ETF is really good if you want to get away from that index approach and narrow down your focus into a specific investment. So why would you invest in the managed fund? You'll probably be looking to invest in a managed fund if you believe the market can be beaten. Because you do have funds managers out there like a Warren Buffett, who when he was managing money, he had a 20% return, or somebody like a Jim Simons who runs Renaissance Technologies, and his return was actually 39.1%, almost double that of Warren Buffett. So that's something to factor in if you believe you can identify these unique managers who can get you this astronomical return, and then weigh in how much money they're going to be charging you for that return. So if you're seeking to get a higher than market return, managed funds are the way to go. So I'm really keen to know what your favorite managed fund, ETF or index fund is. Hit me up in the comment section below and let's get that conversation going. Personally, I like IVV if I'm going for the index approach, but I have been leaning more towards active ETFs in the past 3 or so years. So I'm making a video on my favorite active ETFs to share with you guys for one of my upcoming videos. So please subscribe to my channel and hit that notification bell, and YouTube will let you know when that video is up. If you have any feedback on how I can improve the content on this channel, please let me know. Or if there are any specific topics that you want me to cover, hit me up in the comment section or hit me up on my socials. And on that note, remember to take care of yourselves, take care of each other, and don't forget to call your mom. All right, peace. Listed on the stock exchange. So an ETF, so most ETF, yeah. So just, yeah. So for the benefit, yeah. So for